All right, good Sunday evening, everybody. Haven't done a public macro market video in several weeks. Much has taken place between today's video and the last in the markets, in the economy, in the geopolitical realm, obviously. Speaking to the U.S.-Israel-Iran war. Yes, I know. Only Congress can declare war. So I guess everybody thinks the president's a liar when he calls it a war. Clearly, it's a war. We don't need to nitpick on whether this is a military conflict or a war. Nobody's going to show up at our doorstep going, you called it right, with some kind of trophy or whatnot. It's a war. So with that, we'll check out a few different things that are on my mind, essentially, and what I think will help investors navigate, the current macro market landscape. There is a lot to cover. I don't rehearse this. I have no clipboard, so to speak, as most of you who have watched my videos in the past understand. So with that, just share my screen and we'll dive in and see where this takes us, really. We'll see where this takes us. In this weekend's report to Phenom Group members, we talked about a lot of different subject matter, but mainly, uh, pointing at what you might expect from the markets going forward. And since the geopolitical event and war with Iran started. And so the table that we're looking at here is from Ned Davis Research. And what it basically outlines is, so far as future returns from a Middle East crisis or some kind of, crisis event since 1950, there's a lot of green on the screen, i.e. positive returns. In fact, most of the time periods going forward, whether it's one trading month, 3 trading months, 6 trading months, a full year, most returns are positive. The initial response, in other words, to the conflict, the crisis event, if you will, is usually reversed within a month or so. Um, it also evidences that this is an opportunity if the market is going to have a negative response, which it has already. The S&P 500 is off nearly 3.5% from its all-time high. The Nasdaq is off, I think, 8% from its all-time high, 9%. It's going to be in a correction pretty shortly here if we have some follow-through to the downside this coming week, which I would be of the opinion is the more probable outcome, some more downside. As I opined and posted on in public social media last week, it's fairly simple to guesstimate where equity prices are going in the near term, or equity markets, I should say, because they've been very much tracking the price of crude oil. If crude oil goes up, equity markets are going down. So it's a very easily to forecast regime since this crisis began. I would assume, therefore, if crude oil prices are going up Monday, which I believe they should, there are some weekend, if you will, weekend uh, Globex future markets or spread betting markets that offer such an indication of sentiment. And they look like, we could be 95, 96, $97 a barrel in crude, which would be another, 5, 6, $7 jump and likely to pressure equities. And, to some extent that is a good thing. As I've often said, as the market has always evidenced throughout history, administrations don't make policy. The markets do. There was no clear evidence of this for those of you who are looking for some kind of recency bias, if you will, than last year's Liberation Day tariffs, right? That was kind of the straw that broke the market's back, if you will, market being the camel. The market precipitously fell another, I think, 8% after Liberation Day, essentially forcing a policy shift from the White House administration, right? We had the 90-day pause, once the markets basically said, we're not going to take this. So that's why I offer or submit to you that down is what you want in the near term if you want to affect White House administration policy and how they're going about managing this war with Iran. To the extent that crude oil prices also climb or continue to climb, you're going to get greater inflationary impulse reported in all of the, all manner of inflation data. CPI coming out in the next week or two is likely going to, evidence what we're already witnessing, both in the commodity complex as well as the price of gasoline at the pump, which has, jumped almost 80 cents, a gallon so far as the national average is concerned. None of this is good for the White House administration in the midterm election year. So there are going to be demands on the White House administration. Should we see continuation of commodity prices going higher, equity prices going lower? Hence, the more downside, the more rapid the downside, the better for investors. But it's also, as evidenced in this table here, a short-lived type of situation, a situation that investors have taken the opportunity to absorb those cheaper prices by allocating capital, by leveraging, themselves into the market. They were quickly, if not rewarded, long term. So a good study there from Ned Davis Research. Now, with the continuation, if there is a continuation of downside here in the equity market near term, Monday, Tuesday, Wednesday, we're probably going to break the December low of 2025. That low comes in at 67.21 on the S&P 500. Historically, if you break the December low in the Q1 period of the new year, the odds of a full year return being positive drop precipitously. They go from 75% down to 48.6% historically. And the average return for that calendar year is negative. Now, we had the situation last year. Okay, we did break the December low last year, and yet we still had a double-digit return. Again, keep in mind, this is essentially a coin flip, right? But a coin flip is worse than the 75% probability of all calendar years being positive returns for the S&P 500, right? So it's not a deal breaker, so to speak, but it does lessen the probabilities of a positive return in 2026. Am I of the opinion that we will? Yeah, I am, unless we get some major headline here in the next 24, 48 hours. It's not looking good. And keep in mind, this is on a closing basis, not an intraday basis, because we have broken it intraday. All data on a closing basis. When you look at here also from Ned Davis Research, we're looking at the S&P 500 cycles for 2026. Here's the cycle composite, which is essentially taking the decennial cycle, the 1 year cycle, the 4 year cycle, and giving you an average price trajectory since 1957. And it tends to show a peak in the month of April. If we look at if we separate out the 1 year cycle, same thing. Basically the month of April, you see a peak, some consolidation, some rises, again, rises, but then also troughs here around the same time in October, just ahead of the election, of the 1 year cycle time period. Midterm year, same thing. I mean, every which way we look at cycles, right? Potential analogs. April, we tend to see a peak. October, we tend to see a trough. So I just thought that was notable and or interesting. Um, as of Friday, this past week, with the negative weekly return and momentum really gaining some traction to the downside, we also closed on the S&P 500 and the Nasdaq below the lower Bollinger Band there. Now it's fairly easy to see from the chart. Each time we've closed below the lower Bollinger Band, right, an overextended, if not oversold condition, we tend to see a snapback into the Bollinger Band zone once again. It doesn't have to be immediate, but it expresses an overextended condition. You can get overextended to the upside and overextended to the downside. Right now, we're overextended to the downside, but still might yet see a little more before we get some relief. As I mentioned, you can get overextended to the upside and you check back in to the Bollinger Band zone there. Now, this study here from Blue Kurtic, S&P 500 forward performance since 1958, when you do have this overextended condition closing below the lower Bollinger Band there, 1 month forward, like I said, it may take upwards a month. We have almost a 95% positivity rate. Which is pretty substantial. There's only been one loss, and that was there in 1960. Average return, almost 3%, or the median return, almost 3%. Again, this is in keeping or fitting, right? 1 month forward with that condition is in keeping with what we see here as well from, conflicts around the world, crisis events, if you will, right? Both of them showing very high positivity rates. So, in the context of fear and loathing, which I hope nobody, feels at this present time, it usually pays to keep your wits about you and actually buy those cheaper prices, engage them with a longer term outlook. The one of the ways that I'm engaging the current market environment and where we see no leadership in the market and why we also are seeing the unwind of the everything trade. I'm still going after leadership. No, they're not leading here in 2026, but there's no such thing as leadership that does not include technology or information technology, Mag 7, growth. What I've been explaining or trying to explain for the better part of this year, if not since December of last year, is that the market is without leadership. Now, people have pushed back on that idea, saying, well, no, it's a rotation of leadership. There's just different leadership. Look at small caps, look at mid caps, look at equal weight, look at the cyclicals, look at value. And my response to that is it's not leadership. It's just a rotation of performance, right? We have other areas of the market that are outperforming. Simply put, well, how is it not leadership, Seth? It's leading. Yes, it's outperforming. Outperforming is lead. No, they are two very different concepts. You should not be conflating concepts in the market. Like the market is black and white. When we produce as humans these shades of gray, understand that we are engaging the market with human error, right? It will catch up to you sooner or later if you absorb that kind of belief system. And so my pushback is very simple and what you've seen basically all year, so we can validate my response. So my response to It's new leadership is that leadership should take you somewhere that's sustainable. What's the S&P 500 return this year? Have we been able to sustain anything this year? Clearly, the answer is no for those of you who are actively following the markets, right? Leadership should take us somewhere sustainably. We have a trendless market, if not a market that is down 1 to 2% this year. Tell me more about leadership, right? There's proof there is no leadership. Lesser cap tiers cannot lead you, even to the degree that they are outperforming. The magnitude of outperformance is pretty spectacular. And yet, without true leadership, without large cap growth and tech, we can't get anywhere positive, let alone negative, sustainably. There is no leadership. And in this type of environment where leadership tech is actually getting cheaper, that's where I leverage into the market. Because when the market does find a point at which it inflects upwards, renews the uptrend, it's likely going to be on the heels of true leadership leading the way. And so when we look at this chart here, what I'm trying to evidence is that everybody's buying tech, right? Tech is down year to date. We know that, but everybody's buying it. The hollow candles that you see here in the chart of the Technology Select Sector Spider Fund, or XLK, evidences that we are opening lower, but closing off those lows of the day, if not towards the high of the trading day. That's what a hollow body candle informs. And most of the days since February, we have hollow body candles. There is a lot of buying the dip going on in technology. The bottom panel chart is a stochastic called the accumulation distribution line. And that's almost at the all-time high. Is this the best vantage point for which to rely solely on buying technology? No, it's not, right? This is just a technical purview of, how to better define what others are doing in the market. In my opinion, you buy fundamentals. Technicals just kind of confirm for you, if not lend a degree of confidence and conviction for which to, hey, you're right about the fundamentals, and the technicals are basically saying the same thing. There are a lot of folks buying technology. It just hasn't shown up in price yet. Insiders are buying technology. Look at where we are on the insider buying performance here for the technology sector. I don't make it my business to fight the insiders when they're buying. When they're selling, they can sell for a number of reasons. It does not, historically, insider selling has almost no discernible signal for the price of that stock, sector, ETF, or what have you. But insider buying, they generally only buy for one reason, and that's because they believe it's going up. Selling can be, taking place for a variety of reasons, but buying, very, very finite reasons. Volatility, right? We closed nearly 30 on the VIX this past week, above 29. One of my favorite indicators of all time when it comes to, is it a risk-off environment? And typically risk-off environments are short-lived. And in that respect, they're also buying opportunities. The one standard deviation above the VIX mean is 27.3. Historically, if you're buying above 27.3, 12 months forward, you're almost always rewarded for doing so. And I'm speaking to just the index ETF, of course. But the VIX last week, not only did it close just below 30, but the 10-day rate of change, which is my favorite of indicators, essentially validating the risk off environment and more than likely a buying opportunity, jumped above 50. Bottom panel here, middle panel here is the VIX rate of change, the 10-day rate of change, and it's above 50. Not very often do you see that happen. Maybe once a year and during a correction. And why is it just a correction and not a bear market? Because the 10-day rate of change gets above 50, and that's typically when you're oversold, overextended, as we talked about before, using Bollinger Bands, and this just confirms the same thing. It's actually a buying opportunity. You may not be rewarded right away, but more than likely you will be rewarded in the near term or interim. The chart, the table, or the quantitative study here from Blue Kurtic not just recognizes the VIX 10-day rate of change getting over 50%, but over 50% while the S&P 500 is within 5% of an all-time high. And so if we look at the forward probabilities or positivity rates, let's get to the ones that I like above 70, which is fine 4 days later, 5 days later. I don't like near term, 1 week stuff. I look out month, 2 months, 3 months, 6 months. Indeed, when we look out 6 months, 91, we'll call it 92% positivity rate for round numbers sake, right? One loss since 1990, just one. Right? Buying opportunities. Do you not have 6 months? Right? Is something happening to you? You have a life event that you can plan for 6 months out, right? Like I get it. A lot of people don't want to suffer drawdowns in the median, right? But these are mostly coin flips. You have some 70 percentiles here, but it's too near term for me. Coin flip here, 3 weeks later, okay. 4 weeks, okay, gets better, right? Do you not have this kind of time for which to, instead of trying to time a bottom, instead of selling to raise cash, take your drawdowns like big boys and girls and make sure you're in at the bottom. The number one way to make sure you're in at the bottom is to never get out. You're going to be in it. It's by default, you're in at the bottom by never getting out. And you have data here, if not right here in other, studies that we've already discussed. Now we've got two closes above that standard deviation level in the VIX that I just mentioned, right? 27.3 on the VIX is one standard deviation above the mean. Historically, if you get 11 closes above that level, it has not generated very good returns for the calendar year in the S&P 500. In fact, if you do that 11 times, only once was the S&P 500 positive for the year, and that was last year. Right? Last year we had 14 closes above 27.3 in the S&P 500 and managed a double-digit return. Right? Every other time we had at least 11. At least 11. At least 11. At least 11. So on and so on and so on, except for last year, right? We have two so far, two occurrences above 27.3 this year. This data from DataTrek. So do keep in mind. Also keep in mind, hey, we did have a February all-time high in the stock market this year. Historically, the market doesn't like to just top in the month of February. Most tops occur in December or January. Only one time since 1980 has the market topped in the month of February. Just once. Right? So the odds are we're going through a lot of crap right now in the market, in the geopolitical landscape, and more than likely we're going to continue to see stuff develop as the year progresses in this midterm election year. But this midterm election year may just be the thing that reduces the sensitivity rate around this geopolitical stuff, that seems to pop up in White House, Trump-led White House administrations. It's not an attack on Trump himself, right? I mean, we know he likes chaos, right? He indicts himself upon that. It's his own words, right? You just have to understand the environment and the probabilities based on a Trump-led administration, right? I mean, we had two corrections in 2018, one of which was a bear market in 2018, two corrections. In 2020, of course, COVID and a 35% bear market. Just last year, 2025, a 20% peak to trough technical bear market as well. It's a lot of volatility. Donald Trump is also, as the president, he's presided over two of the highest VIX readings in history. All right. Those are just, lend to the probabilities, how you should prepare, how much cash you might want to have on reserve, if you will, so that you can take advantage of that volatility. Because where there's volatility, there's opportunity, such that he likes chaos. He likes a higher degree of volatility. He also likes all-time highs in the stock market, which have also, been part and parcel for his administrations. Right. Now, this year, one of the things that we had discussed coming into the year, right? Now, everybody seems to know what the high-low logic index is, right? All of a sudden, everybody's talking about the high-low logic index, right? I read Charles Schwab, Liz Ann Saunders. You know how many times I'm a Charles Schwab client. One of my biggest brokerages or one of my biggest accounts is with Charles Schwab, Golden Capital Portfolio, my personal portfolio, right, with Charles Schwab, right? So I get their research every week. You know how many times in the last 11 years I've seen Liz Ann Saunders mention the high-low logic index? Until this past week. Ned Davis Research, high-low logic index, front and center, not just for the NYSE, the NASDAQ, but also the technology sector, which has the highest high-low logic index in history. Some of these regions, whether it's the NASDAQ or the technology sector, they're the highest ever, and not by a little bit. It's not like we're just, slightly breaking out to new all-time highs on the high-low logic index for these areas of the market. They're like standard deviation, 2 and 3 standard deviations above their former highs. Like it's just a ridiculous amount. So my point is, where we've been emphasizing this coming into this year, now everybody's playing catch up, right? They're recognizing the bifurcation in the market, right? The high-low logic index, like a lot of stochastic, like a lot of breadth measures, they simply emphasize or inform of market conditions. Are they strong? Is the structural integrity of the market strong, or is it fragile? Right? We were fragile coming into this year, and as we warned Phenom Group members or those who subscribe to our macro market research report and achieved our full year 2026 outlook, we headlined the risk to 2026 in part due to the fragility of the markets. When the last time we also warned not warned, but opined about the probabilities of a correction in the first half of the year? The last time we did that, 2024 going into 2025, using what? The high-low logic index. Right? So coming into 2026, our outlook report, when the NYSE high-low logic index rises above 1.6 for the first time in 6 months, right? And you can find this study on my X account going back to November of last year, right? The max drawdown from peak to trough on average is 17.5%, 17.28%. The median is 19%. Do you think we're going to get a double-digit correction in 2026, Seth? The markets are fragile. The high-low logic index confirmed that for us. We don't have to get a full correction. We didn't here. But the probabilities are very, very high. We said that going into 2025. We reiterated it because of the market conditions going into 2026. Who did the market understand was going to be in the Oval Office in 2025? Who did the market understand was going to be in the Oval Office in 2026? We will convince ourselves that these events, right, the tariff regime, the market couldn't have known this. This now war with Iran, the market couldn't have known this. The market may not know what's going to happen, what's going to be causal, but it will position based on the probabilities. The market understood coming into 2020, going into 2025 and coming into 2026, who was in the Oval Office and how corrections and bear markets tend to follow that, that president. So it positioned accordingly. The fund flows dictated price, understanding the probabilities of the White House administration. It's not just going to be luck if we find ourselves in a double-digit correction. It's going to be due to the fact that the market understood the administration and the probabilities for policy action. As I said earlier, when it comes to crude, when it comes to the possibility of more drawdowns and even the possibility of a correction, good. You need to have the mindset that down is good. Down is good. It allows you to get into the market at cheaper prices. Do you want to be in the market at cheaper prices? I'd be of the opinion you absolutely do. When we look at full year S&P 500 2026 earnings, right, the estimate is for 15% growth. When you look at technology, mind you, I had mentioned I'm buying technology during this dip, which may produce a pullback, ultimately ending with a correction. Information technology is set to grow 33.2% EPS year over year. Well, what if we just get a lot of multiple contraction here this year, even if earnings grow, Seth? It's possible. Anything's possible. It's just improbable. We'd essentially find the information technology sector back to COVID levels. We don't have COVID, folks. We don't have COVID. It would be also another thing if the free cash flow, if the gross profit margins didn't coincide with the earnings growth potential. But gross profit margins are estimated to be at all-time highs here yet again this year. Free cash flow growth, all-time highs yet again this year as well. You are fighting an uphill battle with what ifs and yeah buts, putting obstacles in front of that capital that you should be allocating based on probabilities, not possibilities. So indeed, I would be buying technology. I will be buying technology. All right, so where does that take us? Let's see. That's a lot of the stuff that I wanted to discuss. So far as what was discussed in our macro market research report to Phenom Group members this weekend. There's a lot more beneath what you've already seen. If you're not a member, subscribe to our contributor membership or our premium membership. Something that I found interesting over the last couple of days or yesterday, Renaissance Macro Research, right? They had a popular post, in 2022, right? This is kind of their macro market post, if you will, looking at the things that are happening geopolitically and weighing them against what we have in our domestic economy. In 2022, there was an energy shock, right? Part of the Ukraine-Russia war involved a commodities price shock. Energy went up, agricultural commodities goods went up as well. We had a strong job market back then, totally agree, and excess savings to draw down, totally agree. Today, the labor market sucks and savings buffers have been drawn down. So something that is, I push back on this understanding, okay? The labor market is not what it was in 2022, right? Even if I give you the most favorable stats, it's not, right? If we look at the last 3 months, we're barely growing jobs. Good news is we're not laying off people, right? It's a low hire, low fire. You've heard that before. Don't mean to seem trite. Having said that, it's stable, right? We've just basically the labor market has softened to a lower level, but still yet an equal amount of supply and demand. Now, as it pertains to the savings buffer, and as I basically commented here, savings buffers, by what measure is being used? Personal savings rate, I don't believe to offer that kind of insight. Most people use the personal savings rate and they see it going lower and lower. Personal savings rate, St. Louis, there we go. Right? I mean, you can't argue, against what you see with your own eyes, and government data is what it is. It is absolutely going lower and at the lowest level since, 2022, right there. Now, here's the problem. The savings rate is a rate of change, right? It doesn't tell you the absolute level of savings, right? It just tells you what's happening on a monthly basis versus the prior month, right? It doesn't tell you exactly how much people are saving or where their starting point even was. It just tells you they are saving less from 1 month to the next. The rate of change is less and less. We don't know what the needs are, right? We can just assume. And that's essentially what I believe is happening here with Renaissance macro research, right? They're assuming because the savings rate is coming down, people are using their income, right, their wages, to offset the price at the pump, to offset inflation. They're just not saving. They don't have the buffer. And the reason I push back on that, even with the San Francisco Fed's report, which basically looks at just the excess savings, right? Right. So the standard deviation, versus where we were prior to the pandemic. It's just a standard deviation above the norm, i.e. excess, right? Excess savings. And they basically say excess savings is gone. Now, there are various institutions who said the same thing in 2023, and then they recalculated, said it again in 2024, recalculated, said it again in 2025. We're just hearing it again in 2026. Right? Once bitten, twice shy, if you ask me. There seems to, and my point being, we're saying this every year. We're literally saying the same things about the excess savings rate every year. We're literally saying that consumers are stressed, strained, strapped for cash every single year. And yet we're still not in a recession, not even close. And yet we still see, record level retail sales. Right? We still see consumer spending positive growth. We're just saying the same stuff year after year, following this metric, which again is just a rate of change, and making the assumption right? We're characterizing the consumer, the household, based on the personal savings rate without recognizing an absolute level of how much money, actual money, accessible cash the consumer has. Let me ask you something. If all you knew was that money market funds are at all-time high, how does that happen? If the consumer is saving less month after month, quarter after quarter, and year after year, and yet they're strapped for cash, they're strained, stressed, the lower income decile is desolate. We've literally year after year after year said the same thing. We can't find a recession to save our lives. So how do you know what the absolute level of accessible cash consumers, households have in the country, right? If this is just a rate of change and we can't necessarily assume why they're doing this, then we probably need to know what their absolute cash level is. And where we find that is with, household checkable deposits and currency. This is actual cash that households, that consumers can tap into their accounts and withdraw for any reason at any given point in time. I'm sorry, I'm just letting this sink in for a second. Right? This is why Bank of America and JP Morgan Chase, right, when they talk about, how much cash the average account holder has as being 40% higher than the pre-pandemic levels. This is why. This is why every time the big money center banks come out and report and speak to a healthy consumer, why they don't see, the damage being done to the average consumer account. This is why. These are absolute levels. This is what the consumer has that they can tap into. This is how ridiculous their starting point is. Let me ask you something. Why in the hell would you be saving more money? More money, right? In your checking account that gets less than 1% of interest. Why would you be doing that? Right? You'd probably put that into a money market account or live. Just go enjoy life. You don't need to be saving more when you have this much money relative to the pre-pandemic era. So when people talk about, we don't have, we had a strong job market. And let me tell you something about the latest jobs report. Well, first let's go back to all the ISM numbers, right? Did you look at the ISM employment index? Mind you, we've had 2 consecutive months where the ISM manufacturing index is above 50. Part of that is the employment component, part of it, not the biggest, but part of it. Biggest is new orders. Right? But 2 months above 50 for the first time since 2021 or 2022 before the Russia-Ukraine event. First time in 3+ years. ADP private sector payroll report grew what, 60,000 jobs? And then we get the non-farm payroll report, the establishment payroll report, and showed a decline of 90,000. That decline of 90,000 was with the lowest response rate to the survey since 2000. Not for round number's sake, since actually the year 2000. 58% response rate to the survey from the BLS. Did you not see the labor force participation rate absolutely plunge? 0.1%, 0.2% on a monthly basis here and there. That's the norm. Nearly a 0.5% decline in the labor force participation rate. And everybody's like, yeah, yeah, I believe that. I believe that. Are you kidding me? And a 58% response rate. Not to mention the weather, right? The weather. No wonder the response rate was so bad. Now, the BLS will get additional responses here in the month of March. They will get additional responses for the February report. And more than likely, that lends itself to a positive revision, when it comes to that negative 90,000 job loss. So, kind of big picture stuff, folks. Don't take one report, to as the be all and end all, to draw conclusions, if you will, like they've done so here. The labor market does not suck. It's uncomfortable because we softened to a level where there's not much job growth. There's not a lot of layoffs. And when we look at supply and demand, they basically balance out. We just don't like balancing at lower levels. It's uncomfortable. And we know we can't be perfect so far as supply and demand forever, right? Something's going to give. And the savings buffer, can we not? Can we not, people? I've done this many times before when it comes to Renaissance macro research. Right? Again, going back to, I chronicle all of the analysts, all the economists out there, because I want to know their efficacy. I want to know, they say things, well, and they have these outlooks, what's the end game? What was the actual, what actually happened? Was their outlook achieved? Here's Neil Dutta of Renaissance Macro Research. Right? There was a slowdown underway before tariffs. Private sector wages, blah, blah, blah. That was Q1. Think about what happened since, right? We're in Q2 when he wrote this. Uncertainty is the enemy of growth, and right now, it's also the enemy of Fed easing. Thus, a reasonable assumption is that the gap between weaker wage growth and the funds rate will continue. With tariffs, whatever goes into P will come out of Q, and nominal growth is already running below 4%. Recession risk is clearly rising. He didn't say a recession was going to happen, but he did say a recession. You can mince words all you want, folks. Right? Neil has been pretty pessimistic on the economy for quite some time, basically since 2023 when we had, certain of the bank failures. Did we have a recession in 2025? No. We even had a quarter of near 4% GDP after he wrote this. Here we are in 2026, going into the second quarter. Still no recession risk rising. It's like the saying the sun is going to rise. No crap. With each passing day, week, month, quarter, to the extent that a expansion cycle, gets protracted in time, you're inevitably closing in on the next recession. We're never going to not have another recession, right? This is a good way of saying nothing but getting your pessimism across. And that's all I think you should glean from this commentary relative to my pushback, right? This is a way of getting your pessimism across. There's always going to be pushback when you look underneath the surface, when you do some deep dive analytics. I think that's all I had for this week. Let's see. We'll run through maybe some recent posts here. The McClellan oscillator for the NYSE, getting close to an oversold signal. An oversold signal comes at -70. Anybody who tells you otherwise can just, it's -70. Okay. That's what it is. We're not there yet. I'm of the opinion we're not going to get this close and not achieve it. Yeah, but we did the last time, Seth. You're right. I don't care. I still don't think we're going to get this close and not achieve it. We need a positive headline very, very soon to avoid this. So be on the lookout. I call it savvy oversold because savvy investors are buyers here. We don't stay down here very long. You're getting cheaper prices with momentum to the downside. It's earnings, folks. I mean, you can opine to your blue in the face about tariffs, an incoming Fed, and the market likes to test a new Fed. No, it doesn't. There's no such thing. There is no such thing as the market likes to test a new Fed. It can is different from it likes to. More often than not, it doesn't. It doesn't. If you look out 6 months, almost always is the market positive after a new Fed chairman is elected, if you will, or appointed. The markets follow earnings. It has a 98% correlation. Can you imagine if we are actually down double digits in the S&P 500? And I mentioned the S&P 500 because it's mostly tech. 32% of the S&P 500 is tech. Right? We talked about the tech forward valuation. If that happens as well, it's going to be back to its COVID levels. Nothing that is happening so far as this war is concerned with Iran touches our domestic economy. Earnings estimates still rising week after week after week emphasizes that. You're getting a fantastic discount if we do get that double-digit correction, which was already part of the framework for 2026. But if there is that positive headline, and I would assume that positive headline is attached to what stops oil from continuously rising, you're going to get a very V-shaped like recovery in price. And more than likely, where the greatest devaluation is taking place, i.e., technology, i.e., growth, is where you're going to get the greatest magnitude of that V-shaped recovery. Just my opinionated fact. All right. And this is how I framed it for our Phenom group members in our Telegram app over the weekend. Just kind of a quick note, a blurb, if you will. We came into 2026 knowing market internal structure was fragile and without leadership, anticipating a 10% plus correction, which hasn't yet occurred, getting closer for the comp Q, NASDAQ. We now have a realized exogenous event, which we do, and why a lot of quantitative data is actually failing its forward positivity rates. Again, the market knows the administration. So to the extent that we've had failures for certain of our quantitative studies, we now have the realization of the exogenous event the market was already pricing. Markets are forward discounting mechanisms. We now have a realized exogenous event, VIX closing nearly 30 and VVIX above 140, actually. This removes a great deal of investor participation for a while. Look, there are a lot of funds out there that they're not allowed, based on their corporate or their firm bylaws, they're not allowed to allocate. They're not allowed to buy market exposure when the VIX is above 20, 25, 30. Like they're going to be cut out, from those cheaper prices. But it is also a lack of fund flows, which promote further downside. You're losing a percentage of participation in the market. You're losing liquidity. It makes it easier for a market to fall that much quicker. The good news is the environment is not sustainable, given midterm election demands for incumbent party, right? Look, if the White House administration wants to, hold on to, one or both branches, the House or the Senate, it's going to have to manage this conflict better, right? You can't lose the inflation fight, as well as having a geopolitical crisis on your hands, at the same time in a midterm election year. So more than likely, they are going to do whatever's necessary because of the pressure on the White House administration each and every passing day that commodity inflation gets more and more out of hand. So there's going to be the same growing pressure on the administration to solve the macro issues as they worsen near term, and in the same manner there were in 2025's Liberation Day, which gave us the 90-day pause. The playbook, therefore, remains akin to 2025's and the opportunity no less. Cash, or if you think about diamonds, right? How are diamonds created? How are your profits going to be created? How are you going to compound returns? Cash, time, and pressure equal profits. The playbook that some of you have probably seen before is no different for me in the Golden Capital portfolio than it has been, from last year. When the market was down 10%, I just added leverage to the market in 1% intervals. And when we hit the 20% threshold, I added 2% of cash into the market. Right? You don't need the market. If you do this exercise, you don't even need the market to get back to 10% for you to be even. All this gets you back essentially to where you were, right? The market can still be down 10% from the 20% barrier or floor, while you've made all of this money based on what you've added to the market. It's just math, folks. It's just math. Most everything in the market is just math. Last but not least, and as I often say, when it comes to the consumer, because the consumer is the economy, 70+% of GDP is consumption. And so far as the consumer strapped, strained, stressed, savings rate is going down. They don't have this cushion. Household debt service payments as a percent of disposable personal income, still at basically the best level in history. We X out that post-COVID because you had all those cash transfers, those government transfer checks to households during that 2020 into 2021 time period. But if you remove that, we're at the best level. This is the household balance sheet, essentially. The household balance sheet, the median household in the United States, this is their balance sheet. And it shows it's basically the best in history. You can go all the way back to 1970. 1970 is the last time we were at these levels. Right? So when people tell you there's no cash buffer, job growth, the labor market sucks, like the household balance sheet is still very strong. Something that I also had said, when I look at this post here, 2 years ago, I said, don't be surprised if we see delinquency rates suddenly surge. Not because, households have just gotten that stressed, that strained, as wage growth starts to dissipate and we still don't yet have a recession that resets prices, i.e. inflation. Don't be surprised if you see delinquency surge, but not because of those reasons. Rather, the cost benefits analysis says it's the smart thing to do. Imagine you have a credit card and you got to pay $100 on that credit card every month, right? It's taking away from other discretionary expenditures, right? It's a nuisance, but you already have the job. So you have the salary. You can't pay it. You've been paying it. It's just a nuisance at this point. You have the job, the wages. You have the car, which most people have, and you have the house, which most people got with those low mortgage interest rates, from 2020, 2021, and into 2022. You've got the big three. What do you need the credit for over the next 7 years if you go delinquent, if not default on that credit card? What do you care? You don't need the credit. You got the big three that you needed the credit for. And wouldn't you know it, here we are 2 years after I said that, where we have the highest delinquency rates of the expansion period, right? The cost benefit analysis says that's the smart thing to do. Stop giving your money back to the credit card company. Stop paying your debtor or your creditor, when cost benefits analysis says you'd actually do yourself a favor if you don't need the credit over the next 7 year period. The average car loan nowadays is 7 years. And we just happen to be seeing a surge in those default rates. Again, a lot of these institutions, whether it's JP Morgan, Goldman Sachs, or even the likes of Renmac, they use old models. They go based on the same presumptions as always, right? But when we have conditions such as these, where you have such a dramatic change in household balance sheets, in their actual checkable deposits, in their account, behaviors change. We start to do a different calculus. The institutions, they don't like doing that. They don't change with the times, even though the times they be a changing. So with that, I hope you enjoyed this weekend's video. Have a great trading week. And do check out phenomgroup.com for our macro market research. Take care, everybody.